Contrary to most physicians, I really like to talk about taxes. And mainly, I want to talk about, what are the taxes that are important to us as healthcare professionals and more importantly, as physicians. The reason I say this is because the biggest destroyer of wealth is not inflation, is really not how the market is doing or how it crashed, but the biggest destroyer of wealth is in fact taxes if you live anywhere in Canada. And so for this reason, I want to know more about it because you and I work really hard for the income that we make. But if all that goes into taxes, then we're just spinning our wheels, or we are running the rat race, or we are running on the treadmill like a rat without no end. And so how do we do this more efficiently? Well, really, it's to manage the biggest wealth destroyer of all, taxes. So I hope that you enjoy this episode and that you come out on the other end having learned something new to help you with managing your own personal finances. Enjoy!
How's my financial health, Doc? Welcome to the Financial Literacy Podcast for Healthcare Professionals, where financial security and wealth topics are not a taboo.
Okay, well, welcome to the show, How is My Financial Health Doc podcast, and I am Vu Ketran. I'm happy to be back with all of you. I would like to welcome back to the show Normand. Normand, how are you doing?
I'm doing great, Vu. Yes, it was a challenging tax year this year. CRA threw us a few curveballs, but touch wood, we didn't miss any deadlines.
Very good. Yes, there's going to be a few curveballs that we can chat about today as well. And one of them was about the capital gains tax, right? Increase, which happened but didn't happen, but happened but didn't happen. So a lot of curveball for you and your team for sure. I don't know if you guys remember, but Normand is an accountant from Hull and Associates. And the reason why I like to talk to Normand is because one, he knows taxes very well. He knows strategy very well. And when you put tax strategy together, that's an even more powerful combination. And Normand is really strong in trying to help his clients and his customers to not just do taxes and file for taxes, but actually plan. And I think that's the important part of taxes that we don't talk about is the planning and the strategy. Normand, tell us a little bit about yourself and your practice.
Well, thank you, Vu. We are a group of 6 right now who specialize in tax planning effectively. And as an accounting firm, yes, we do some bookkeeping and accounting and tax filings to keep our clients compliant. However, we do go above and beyond, I'll say, your stereotypical accounting firm, and we get into comprehensive tax planning where our clients will benefit from minimizing not only their personal taxes, but their corporate taxes as well. And not a whole lot of people understand the need for proper planning and the availability to plan in such a way to minimize their income taxes.
Yeah, I mean, I learned that the hard way. As a physician, I work and work and work, and I put my head down. A friend of mine told me, "Vu, just put your head down and work." Okay, so that's what I did for many years, and never really paid attention to my finances, let alone taxes, because who wants to talk about taxes? No one wants to talk about taxes until I realized I need to talk about taxes. That's when I got
It's
interested. And so, we don't think about this, and tax planning is a major element of proper financial planning and also wellness, financial wellness. So I'm definitely happy to have you back on our podcast and talking about this today.
Well, thank you. And unfortunately, finances and taxes are taboo subjects in most families. So, and it's a lot of it is not taught in school. So you don't know what you don't know. And then when you start working and you get busy with your career and your family, it's something that's often left on the back burner. But here at Houle and Associates, this is where we like to start the conversation and discuss planning issues with our clients.
That's exactly right. So one can ask, but Vu, why are you so interested in taxes? Why are we talking about this today? I thought you were going to talk about how to make more money. No, that's not what I talk about. This is not what the podcast is about. The podcast is about, financial wellness and well-being and security. And I'll tell you what, one of the first few books that I read that is a non-medical book is a book called Beat the Bank by Larry Bates. And I came across this book. And by the way, I had Larry on my podcast in my first year of my podcast. So if you want to go back and listen to that. But the reason I bring this book up is because this is the first time in his book that he put it in very clear terms to me what is going on in Canada. So I'll explain what I mean. So his wealth formula was, the investment expressed as the amount of money you put in, multiplied by the time that you put in, and multiplied by the rate or the performance of the investment, and then minus the fees, minus inflation, and minus one of these things called taxes. I don't know if you've ever heard of these things, taxes, right? In Canada, we don't have such things until I realized, oh my God, we do have such things called taxes. And they are very, very predominant in our culture, in our way of living. And then I realized that, you know what? Out of all the things that I can control, I can't control inflation. I definitely cannot control the fees that, different institutions are charging me. I can't control. To an extent, I can buy ETF that are lower than mutual funds, and I can try to find the cheapest financial advisor I can find, right? To some extent, I can, but the cost effectiveness is not as much as me properly planning my taxes, because I can really do a dent if I can plan my taxes well. And that's when I realized there is no point in me killing myself making money if I don't keep most of it. And keeping most of it is really trying to manage taxes. And it was like a light bulb going in my head. I was like, Vu, you can do 50 shifts in 30 days and kill yourself and do all the night shifts and make all this money and give it to Justin Trudeau. Oh no, sorry, Mark Carney now, and give it to Mark Carney. Or you can work 20 shifts and not give us much, and you'll still be in the same place. And I realized that is very important. And Normand, to your point, it's not about just filing, it's not about just being compliant, but how to actually plan for that, right? That was a big eye opener for me.
Yes, and that's why in the Canadian Tax Act, within the first sections, it does stipulate that an individual can organize their affairs to minimize their taxes. We're not talking about evading taxes, but there are ways to avoid taxes.
Neither Normand or I are here to tell anybody to evade taxes. Okay? We're here to make sure that we're planning appropriately, so that we can minimize. Or, I heard this on another podcast. Everybody needs to pay taxes, but not more than what we need to pay, right? We need to
Exactly.
pay our fair share and not more. Let's just talk about, the biggest wealth destroyer, taxes. So we're going to cover a few topics today. We're going to cover, the topic of personal tax versus corporate tax. We're going to cover what incorporation means, why, who, when, why should I even do it? And then I want to bring up the concept of deemed disposition on death, because guess what, Nama? I didn't know what that was until maybe 4 or 5 years ago. And I've had an accountant for many years, and I've been in practice for 25 years. And I'm like, what is deemed disposition on death? And then when I realized that, I'm like, oh, I really need to understand this. Because once I understand this, then it really changes everything. It changed everything for me because it changed how I see things, how I plan things, and how I schedule my shifts really. Because I now, based on that, do proper planning. And so I no longer work just for the sake of working. I work intelligently. The comment that I made, one of my friends says, "Oh, just put your head down and work." I think that was probably a very bad advice. Put your head down and work. I don't think that was a very good advice. So I'm telling you all out there, please don't do that. Don't put your head down and just work. Work, but work smart.
Yes, that's that. I often say that we're working smarter, not harder, and taking advantage of the tax system that we have, essentially to minimize your taxes. Nobody wants to pay taxes, but like you said earlier, we should all pay our fair share.
Correct. And then the final topic that I think we'll address today, which is very important, if you're incorporated and you do invest within your corporation, so you now don't have just active income. We'll talk about what active income is, and you will have passive income if you're invested inside your corporation. And then we'll talk about this, small business rate clawback, or I like to call it the pig, passive income grind. What happens to your corporate tax rate when you make a lot of money with passive income? That grind, what does that mean? And this is a fairly new concept, correct, Norma?
Yes, it was introduced back in, well, new if you want to talk about 2017, when the concept was first introduced by the government and has since been implemented. The concept is new if you're only 7 years old, because that's when it was first introduced. And what we're talking about really is the ability for a individual who has a corporate investment to again minimize his taxes by strategically investing within the corporation.
Yeah. And finally, we'll address, well, so what are some of the solutions to all of these tax issues? So, Norma, you ready?
Yes, sir.
Let's put our running shoes on. Let's start with the first one, personal taxes versus corporate taxes. So maybe help us understand what's the difference in Canada, and why should I pay attention to personal taxes, and why should I even learn about corporate taxes? I'm not incorporated yet. Why should I understand this?
Okay. Well, the Canadian system is built on a principle of the ability to pay, meaning that a person who earns more will pay more. And that's under, I'll call it the fairness program that the government has introduced since 1971. And basically, personal tax rates, as we know, there are several brackets. So if you're, like you mentioned, Vu, the more you make, the more you seem to be paying, and everybody seems to be on this wheel just spinning around, and the more you make, the more you pay. However, on the corporate side, there's only two tax brackets, and the cutoff is when your profit is at $500,000, meaning that the first $500,000 of profit are taxed at a combined federal and provincial rate in Ontario of about 12%, 12.2%. Any profit above the $500,000 mark is taxed at 26.5, like more than twice as much. So many planning strategies are to have the corporation report a profit of $500,000 or less to pay minimum taxes. Unfortunately, when you're an individual, let's say you're a sole proprietor, you're not incorporated, you're running your practice, every dollar is taxed. And of course, it's on a gradual scale. So whereas in a corporation, you're taxed at, let's say, 12.5% at the corporate level. But as you're drawing money to survive, to support your lifestyle, you're only taxed on that portion that you pull out as an employee, as a salary from your corporation. So what inevitably happens is that sometimes you'll have excess cash accumulating in a corporation because you've only pulled out what you need to live on. So again, there's a way of deferring taxes inside a corporation by doing that. So what we're looking at really is proper planning to minimize taxes both at the corporate level and as an individual.
So just to give an example, most physicians, dentists, I would say lawyers are definitely not the lower tax bracket. Accountants too are not in the lowest tax bracket. They are most in the highest tax bracket. So combined provincial and federal in Ontario, I know it's a little bit different in Alberta, it's a bit lower in Alberta, but in Ontario, what is the combined tax rate at the
Right now
highest tax bracket?
it's at 54% roughly, at the highest tax bracket. So if an entrepreneur or a physician or any professional that earns income more than 250,000, that's where they're in that highest tax bracket of 54%. Now, again, with the on the personal side, it's gradual with several tax brackets. So you're not paying 54% on every dollar. You're only paying 54% on anything that you earn above that $250,000 mark, let's say. Um, but it's one way to spread the wealth, so to speak, that if people are in certain tax brackets, they'll pay a lower tax. But if somebody's typically earning more than 250,000 in Ontario, they're going to be paying the highest tax on those dollars above 250.
Right. So what that means is if you're not incorporated and you're in the personal side of things, so someone who's making, let's say at the example of 500,000, right? The marginal tax rate for that person who is 54%, right? But in the corporation can make 500, but the person, the individual only takes 200, for example. So there's 300 left in the corporation, and then the individual is paying taxes on the 200, which is not the marginal tax rate of 54, right? That's how that works a little
Exactly.
bit.
That's
And
right.
and the amount left in the corporation can be invested, can be saved, and pay a lower tax rate that way.
Yes, exactly. That's right.
In your mind, or when you see clients, what are the some of the, and we don't have to name all of them, but what are some of the major factors that will come into play in discussing whether someone should incorporate or not incorporate? Again, I don't need to know, I don't need to know why. I just need to maybe what are the elements, just so that the audience who's listening, who's not incorporated right now, and say, actually, I have these same factors. Maybe I should consider it. So, what are the factors that you use to say we should think about incorporation?
Okay. Well, the flags that come up when during a conversation is, I'm trying to maximize my RSP. I'm trying to save for my kids' education. I'm also, struggling with paying too much tax. So those things trigger us to say, okay, well, let's look at your household budget, and let's say Mr. and Mrs. Smith, where Mr. Smith is an employee for a company and earns $150,000. But Mrs. Smith is self-employed and she's earning $500,000 a year. So, like you mentioned earlier, she's in the highest tax bracket, or half her income is at tax at the highest bracket. Mr. Smith, his taxes are paid every 2 weeks on his paycheck, so he has less flexibility. But combined, I mean, their take-home pay after taxes might be in the neighborhood of 15 to $20,000 a month, but they only need 10 to survive, for paying their mortgage, their car payments, the food, the kids. So, one way for the family to save taxes is we could incorporate Mrs. Smith's business and have her draw only income that she needs. So let's say Mr. Smith, if they need 10 and he's pulling in 6 of that net after tax money each month, that means Mrs. Smith only has to make up 4,000 a month. So she only has to pay herself, $60 to $70,000 salary to meet the household budget, I call, and leave the rest in the corporation to be saved or invested for the future. And she can defer the taxes inside that corporation for when they need it. So this is kind of one approach that I like to use with these clients that are not incorporated and say, this is how we do the planning and do the calculations for you and kind of work it backwards. You tell me I need X dollars a month, but Mr. Smith is already bringing in so much money and he has no choice other than, he might get raises throughout the years, working for the same employer. But Mrs. Smith, if she's not incorporated, all that cash is coming into the family. She's paying it a lot in taxes. And so they'll often say, well, geez, I'm having difficulty meeting ends meet because the tax man is taking all my money. So what we do is we talk about structures and see what works best for the family.
Okay, so one of the elements that you're trying to say is obviously the family budget. The cash flow definitely comes into play, one of those factors. Another factor is how much do I need to sustain and maintain the lifestyle that I want? And then you mentioned children, and you mentioned also savings. So all that comes into play, and these are the factors that you consider. A lot of the times, my colleagues will say, "Well, I use everything. I spend every single dollar that I make, right? I make 500 and I spend 500,000 and one penny. Like there's nothing left in my corporation and I don't need to incorporate, right? Because again, they use every single dollar. What are your thoughts on that when they say something like that? Or is there still opportunity for planning?
Oh, absolutely. I mean, and you're right that is a common saying that we get from those clients saying, well, how can I save money? I spend everything I earn. Well, you spend everything you earn because a tax man is taking more than they should. But by incorporating that $500,000 and only pulling out, let's say, the 150 that you need, you're left with monies inside a corporation that could build ultimately your savings plan for down the road. So that's where, we'll do the math for them and show them that, there is no money at the end of the month because you're paying too much tax as an individual. But if we were to earn that money in a corporation first, then the corporation, if it's only paying 12.5%, let's say, you've got 88 cents to invest after you've taken out your salary. Really, it's getting down to what the family needs. And I term it the household budget. You can give it any other name, a cash flow, statement. But at the end of the day, really, we're looking at supporting a certain lifestyle, and also setting aside for emergencies. If you're feeling stressed today that I'm spending every dollar I earn and your furnace blows or your car craps out, where am I going to get that extra money?
Well, the emergency fund is something that we should address at some point in our discussion as well. So the incorporation can allow that because again, you may be in the lower tax bracket of 12.2%. So I think this is a good segue into incorporation. So you have convinced me, Norm. I am going to incorporate. Let's do it. So now the question is, what are some of the other advantages of incorporation? How does it help me plan for taxes other than the tax rate that we talked about? Are there other elements that we haven't talked about or haven't thought about in terms of proper tax planning strategies with a corporation?
Yeah, essentially when you're incorporated, I say it further defines the individual and it separates you from your personal life to your work life. You know, you're running separate bank accounts to keep everything separate. You may even have a corporate credit card, again, just to keep your spending separate from your personal versus business. The incorporation allows you to pay yourself actually in two different ways because you're the owner of the corporation, you're a shareholder. So shareholders are allowed to pay themselves dividends, and but dividends are paid in after-tax dollars from the corporate perspective. So that means that you as the individual, when you receive a dividend, are actually taxed lower than a salary because the corporation has already paid part of the tax. However, the Canadian tax system has it such that the combined tax between you as the individual and your corporation is still going to be the same as if you paid yourself a salary or the same as the unincorporated colleague next to you. But at the end of the day, the incorporation will allow you to really control how and when you get paid and how much tax you're going to pay. So you might have some months that your bills are a little higher, you may pay yourself a little more. Unlike somebody who's not incorporated, the money comes in and you pay your taxes whether you need it or not. So that incorporation process gives you the opportunity to really control your cash flow, if you will. And then the money's left in the corporation can be invested or saved and further deferred taxes because you will pay taxes ultimately when it comes out of the corporation, but now you get to control how and when that happens. The last thing with a corporation, and I got to talk about a myth out there that, well, if I'm incorporated and my business or something goes sideways, somebody wants to sue me, well, they'll sue the corporation and I'm safe. Well, unfortunately, that's no longer true. The courts have kind of have been awakened by the concept that they're going to lift the corporate veil. And that means when somebody sues your corporation, they'll also sue the owners or the directors or the people actually involved in providing the goods or services. So we always recommend talking to an insurance person about liability insurance, specifically director's liability insurance. So these are things inside a corporation that the corporation can pay for. This type of insurance is totally tax deductible, but it's another safety net for somebody who's in a business or a practice that might be at risk of frivolous lawsuits. Now, those are the advantages of a corporation. Disadvantages, in a sense, not many, because if you're already self-employed, you're still making the same money, you're still allowed the same deductible expenses. You know, the only difference is that now with the corporation, it requires a separate corporate tax return. So it's a separate reporting. So there's added costs there. But believe me, the benefits and the tax savings far outweigh any cost of having a corporation.
100%. 100%. I mean, no, 105% agree with you. A lot of my colleagues are saying, well, I don't want to incur that additional cost to file for the corporation. And I said, well, how much does it cost? Like, how much really? Let's look at how much does it cost for you to file. If you did ask your accountant to file both the personal and corporate, how much additional incremental fee is that? You know, typically we're talking about 2, 3,000 incremental, if right, norm. It may
Correct.
not be
Yes.
even that much, but like you say, the additional value and benefit is so much more. You talked about a few intangible benefits. And I don't know that people realize what you said. Let me just unpack a little bit because we talked about, of course we're talking about taxes, we're talking to accountants, of course we have to talk about money. But you mentioned a few things that are not money related, and that is being able to control your destiny, being able to control your cash flow, being able to control how much taxes you're going to pay this year, being able to control and have flexibility has nothing to do with a monetary amount. It has to do everything to do with how you want to plan your life and your career, which is an intangible. It's psychological, it's emotional, right? Ability, that ability to control is huge because it can reduce your stress. It can reduce some of the elements of uncertainty because now you can play around. Obviously, with the counseling of your accountant, you can play around a little bit with, how much taxes you're willing to pay this year or you anticipate paying. So that's one, I think, intangible. Another intangible is, you mentioned it in passing, is, using 87 cents on the dollar as opposed to using 50 cents. Oh, actually, that's not true. 46 cents on the dollar, right? Because it's 54%. So using 46% on the dollar. So, one of these examples is, for example, life insurance, right? So if I buy life insurance on the personal name, then I have to work twice as hard to purchase the same amount of insurance. Whereas if I purchase it inside the corporation and then I'm using 88 cents on the dollar, 87 cents a dollar, well, I don't have to work double as hard. I can work maybe 1.2 as hard, but not two times as hard. And so there are some advantages of the corporation that allows you to purchase certain things at a much more efficient cents on the dollar. Unfortunately, the courts have lifted the corporate veil, but like you said, that has been the misconception for a long time, is that the corporate veil could not be pierced, but now it has.
Yeah, the corporation no longer acts as a legal buffer if something goes sideways in your business. And that's something I stress with our clients that come in with that misconception that, oh, I'm going to incorporate because I'm going to protect myself, protect my family. Not so if you don't have the proper insurance in place.
I think that's a topic we need to address in the future, Norm. The piercing of the corporate veil and proper insurances for the corporation. Definitely a very important topic. Okay,
Mhm.
so um, the last thing is the cost of the additional work is also a tax deduction to the corporation, right? So the accounting
Absolutely.
fees, the legal fees, all that are tax deductible to the corporation. And so it may not seem as high as one thinks. And unfortunately, many see the tree but not the forest. And it's important to see the forest and go beyond the tree. So there are some advantages to the corporation. There are some minor disadvantages, but I think, like you say, the benefits outweigh the disadvantages.
Absolutely. Yes.
Okay, so now we are going to talk about one term that changed my entire life. Like literally changed my entire life and how I see things now. When I say how I see things, how I see financial decisions. Okay? How I see financial decisions. And this term is called deemed disposition on death. And it's a very powerful term and it's a very powerful concept. So I don't want to mess it up, Norma. Please tell us what that means.
All right. It's a concept in the Canadian Tax Act whereby when an individual passes away, and we all will, the government has decided that the day before you passed away, you actually sold everything you owned. That means the car, the cottages, the investments, everything you own is deemed sold or deemed disposed of the day before, which means that in the year of death, when somebody's preparing what we call that final tax return, we have to claim that you've sold those properties. And let's take the example of a cottage. If you inherited it or paid, 300,000 for it, but on the day before you died, it was worth 1 million, you're deemed to have sold it for $1 million. And so automatically the estate has triggered a $700,000 profit and or a capital gain as they call it, and that becomes taxable on that final tax return. Now, we talked about capital gains and the changing rates. It's still at 50% today, which is by law. And so out of the $700,000 profit on that final tax return, we're only going to pay tax on 350,000. Well, it's still $350,000. So again, we're talking about that highest tax bracket. So worst case, you're paying half in tax. So now you got a $175,000 tax bill and nothing happened other than the person who owned the cottage has passed away. So how is the family supposed to pay the $175,000? And often this is this can be covered with life insurance policies, or worst case, the family has to sell that cottage to get the cash to pay the tax on it. So if it's a family that has enjoyed the cottage for a number of years, and all of a sudden mom or dad passes away, what do we do? You know? And so it leaves a lot of people high and dry, so to speak, and looking for solutions. And so this deemed disposition concept is really the government's way of saying, hey, you know, you've enjoyed that cottage, but it also appreciated in value. So now you've got a capital asset on your hands. We want the taxes now, unless it is transferred to a surviving spouse, then we can defer the tax. But even if it's transferred through a will, there's still taxes to pay because there's going to be a change of ownership on that cottage. So the government has you, in a very unfortunate situation when somebody passes away, and this deemed disposition is a surprise to most because most people either aren't aware of it or don't plan for it. Like I said, you can get around it by, investing in insurance policies. They talk about death and taxes being the two guarantees in life. Well, there are ways to prevent that tax man from taking it all away from your family.
Correct. So a lot there to unpack. I just want to unpack a little bit more because one, death is 100%. Being a physician, I should be very aware of that. Don't you think, right, Norma? Being a
Absolutely.
physician, I should be aware that death is 100%. But if you speak to my colleagues, they have no clue what that is. They're like, Vu, what is death? There's no such thing. So why am I saying this jokingly? Because one, they don't know this concept of deemed disposition. Two, because they don't know, they haven't planned for it. Three, I will never die. I will live forever, so I don't need life insurance, right? And so jokingly, I say that as physicians, we should be even more acutely aware of this than the regular population. But we're not. We're not. Unfortunately, we're not. So that's problem number one. Death is 100%. Now, let's just think about this, that this deemed disposition concept applies to all assets except the primary residence, right?
That's correct.
There's
Yes,
no capital gains on primary residence, but everything else there is, right?
that's right.
Your non-reg savings account, your corporate non-registered savings account, your RRSP, your cottage, your rental properties, the art that you accumulated, the car and the Maserati. I mean, Maserati depreciates and alcohol depreciates. But, if you had something that appreciated, all things, all assets that appreciate are now subject to this deemed disposition. Now, forget about the art and the Maserati. Just think about the money that I saved in my corporation, right? So I set up a corporation. I made 500, but I only used 200, and I used my 300 to invest, right? Over time, it's not 300,000, but more like 10 million, right? Or depending on the market, right? Let's make the math easy, 10 million, right? So at time of death, that has to be deemed disposed. And by the way, Norma, it's at fair market value. right?
That's correct.
It's at
Yes.
fair market value.
And in the case of a corporation, that individual is deemed to have sold their shares of the corporation. So you might have an investment portfolio of 10 million, but you might have, some medical equipment in there. You might have some other assets, um, that are investments that are not part of your portfolio. But when you're deemed to have sold the shares of the corporation, then a business valuation has to occur. And then we get the fair market value of your corporation at that point, which may far exceed the 10 million.
Right. And correct me if I'm wrong, Norma. Most of us set up our corporation with $1 per share.
That's correct. Yes.
So now you set up your corporation with $1 per share, and now you end up with more than 10 million. You imagine the capital gains on that.
That's right.
Okay, so joking aside and laughing aside, so all these assets are deemed to have been sold at fair market value the day before you died. But remember, you're already dead. But your estate now needs to deal with this. And so why this concept has been so important is because, like all professionals, I'm not going to say physicians, because all professionals do this. Doctors do this. Dentists do this. Normand, accountants do this. Lawyers do this. We work hard. Like we work really hard. All professionals, for some reason, we love to work hard, right? So we work really hard, long hours. We sacrifice family dinners. We sacrifice weekends. We sacrifice trips. We sacrifice, my daughter's recital, my son's soccer game, right? We do all that. Do you recognize yourself in that, Norma, a little bit?
Absolutely. Been there, done that.
Been
Miss
there, done that.
a lot of firsts with young kids. Yeah.
Absolutely. So we do that. We sacrifice all that. We accumulate that 10 million, right? Just
Hmm.
using that example of 10 million, we accumulate that 10 million. It may be more, it may be less. I don't know. But you sacrifice all that. And then at the end, it's only after you die that you realize, oh my God, more than half is gone.
Absolutely. Exactly.
And then in your grave, you roll around and you toss and turn and you say, why did I do all that?
Yeah. No regrets, right? That's what
Right?
we want.
So this concept of deemed disposition hit me like a brick. And at some point I realized, why am I doing all this? And I mean, some of us like to work. I mean, let's be honest. I like to work. You
Yeah.
like to work. Like we're all
We,
workaholics. We love it.
yeah. Well, we have the intellect to do it.
Yes, we have the intellect, we
And
have the joy.
strong work ethic. Yeah, strong work ethics and come into
We
play
love
as
it.
well.
So it's not like we're gonna stop.
Hmm.
But can we plan properly so that we're not giving half away? You know, I mean, yes, I made a conscious decision to not skip out on my son's soccer game. I made a I made a purposeful decision to go to my daughter's recital. Um, you make a purposefully decision to go on that family trip, right? And
Yes.
so those are the things you can do and plan. But from a financial and accounting perspective, what other things can we plan? And this is where someone like yourself, who's not just, a bookkeeper and filing taxes, but someone who actually plans for taxes and strategize will help you deal with this. And you mentioned one of them is life insurance. Oh my God, you know how much I love to talk about life insurance. So you just made me really happy.
Yeah.
So life insurance is one of those solutions. Does it fit for everybody? No, but it does mitigate some of these deemed disposition problem, right? We'll talk about at the end what are some other solutions.
Well, and the biggest one in this case when we're talking about death is a proper will.
Absolutely.
Statistics show that 62% of Canadians do not have a will. And guess what happens when somebody passes away without a will? The government steps in and it decides how and when your assets are distributed and so forth. So just having a proper will, and in the case of a professional who has a corporation, you're actually allowed to have what they call a business will, or some lawyers refer to it as a dual will, whereas you would have all of your personal assets listed under one will, but your corporate assets under a second will. And because the government recognizes that we only pass away once, thank God, they will most likely probate the first will, but they won't probate the second one. So if you have $10 million in your corporation and it's not probated, you're protected that way too.
That's an excellent point. Excellent point. Some of my audience will say, Norma, what is probate? So very important concept as well. I mean, probate is really a fee, right? Because um, at the final destination, which is a really bad movie, scary movie, I don't even want to watch the movie. But at the final destination, when money needs to be distributed in exchange of hands, the court needs to make sure that it's done orderly, fairly, reasonably, and so there's going to be what I call legal fees and court fees, right? That's what probate really is. And in Ontario, these fees are not small, especially when you have, assets of 10 million or more, because the probate fees increases with the amount of assets that one accumulated in their lifetime. So, like you say, if you're not well prepared, some of those fees can just disappear in legal fees and court fees.
Absolutely. And right now in Ontario, the probate fee is roughly about 1.5% of your assets. So if we're talking about that $10 million that you have in your corporation, well, 1.5% is $150,000 that your estate has to deal with over and above the deemed disposition tax we talked about earlier. So, there's hundreds of thousands of dollars that can be saved just by getting the proper advice and getting and planning.
Right. And someone will say, well, what's 1.5% out of 10 million? Who cares? Well, 1.5 million, 1.5% is 150,000. Imagine that you're able to, let's just say, save most of that, right? Of that 150,000. That's 150,000 that you can donate to your favorite charity, that you can give to your hospital, that you can give to your favorite pet shelter, whatever it is, right? It's not
Yeah.
it's not small amount.
No, exactly. And you're living today, and if somebody dropped $150,000 in your lap, would you turn it down?
No, absolutely
Like,
not. And for a lot of these charities, hospitals, they do need that 150,000, right?
yeah, absolutely.
So funny story for you, Norma. Funny story. You were talking about 66% of the population don't have their wills. I don't know if you have statistics for physicians or not, but I guarantee you it's more than 66%. Um, and I'm one of those bad ones. I Prior to the pandemic, I was, thinking of doing a will because I have children, thinking of doing my will, and then procrastinated, and I got it done in February 2019,
Oh,
and I
wow.
and I
Good.
signed it just before the pandemic hit,
Wow. Okay,
right?
good. Good timing for sure.
Good timing, but you think back, you say, what if, in the emergency department, you're exposed to all sorts of things, including COVID. What happened if I had died and without a will, right? I would have died intestate, that's the term. And
Yes.
then the courts will have to deal with my children, not my wife.
That's right, exactly. Yeah, so it's very important, and again, it's one of those things we have with all our new clients is getting a will, getting proper insurance, even disability insurance. You're self-employed. What happens if something happens to you personally, physically? Who's going to bring in that money every week, every month? So that's part of the service that we offer here is when we talk about a comprehensive tax plan, well, we try to, take a holistic approach and really look at the family unit and see what best suits them.
You made a great point. Um, so it's really all in the planning, right? Because we know there's a final destination. We know death is 100%. So having that certainty, how do you plan for it? what are the different elements, what are the different factors, financial wise, tax wise, that needs to be discussed. And I know many people don't want to discuss death. I get it. It may be philosophical, it may be cultural. A lot of them is actually cultural, emotional, but it
Hmm.
still needs to be it needs to be discussed. And for me, this concept of losing more than 50% of my assets at the end was really not appetizing at all. And what were the things that I needed to do, and how did I change how I did things, how I personally with my family, how I did things professionally, how I invested, how I mitigate tax, what type of life insurance am I getting? Am I getting term? Am I getting whole life? All that, all that is with the deemed disposition in mind, among other things, of course, but
Yes.
that's a major one. And disability, like you say, it's another one of those elements that need to be planned.
Yeah, absolutely. And this is what's the saying? If you fail to plan, you're planning to fail.
Absolutely.
Um, another good saying that I strongly believe in, because like you said, we are in control of certain things in our lives, so why not do proper planning?
Right. Now, there are a lot of things we can control, but there's a lot of things we cannot control, right? So I don't spend my energy trying to control things I cannot control because I'm going to go crazy because I can't control them. So I might as well control what I can. Okay, so I can control what type of life insurance I'm buying, or if I'm buying life insurance, I can control whether I'm buying disability insurance or not. I can control whether I invest in a mutual fund or invest in a REIT or invest in an ETF or an index fund. I can control that. I can, to an extent, control how much I pay taxes this year versus next year, right?
Correct.
I can
Yes.
control how much I pay taxes based on incorporating, not incorporating, passive income, active income. Uh, I can control many of those things. And because I can control the taxes to an extent, and it is the biggest destroyer of wealth, it has become a very large component of my planning.
Oh, absolutely. And there are many strategies to, like you say, mitigate the taxes, but also let you sleep at night, give you peace of mind, that all your ducks are in a row, and that God forbid something drastic happens to you or your family, you're prepared. And not enough people take that into consideration, and often surprised, and it destroys a family very quickly when things aren't, things that could have been prevented are not acted upon.
Absolutely. So let's talk about one last concept before we talk about solutions. One last concept is the concept of passive income and active income inside a corporation. And what does that mean to your corporate tax rate?
Okay, so we talked about, the 12.2% tax rate versus 26.5% in a corporation. Those are for what's called active business income. So that's when you're actively working, providing, goods and services to clients, customers, patients. Um, but the opposite is passive income. So this is money that is earned by a corporation that you earn in your sleep. So a good example is interest at the bank. So you have money in a bank account, and the bank is, you know, paying you interest, 1, 2, 3% in your bank account, because they're going to turn around and take that money and loan it out to somebody at 7%, and they get to keep the difference. But when its interest is earned in a corporation, it's automatically taxed at the highest rate. It's at the 54% rate. So this is kind of a deterrent that the government has introduced over the years, that they want um, people to not invest in a corporation in a sense. I mean, like I said, the good news is you get to keep 46% after tax, but who wants that? Same thing with rental income inside a corporation. So net profits of a rental property are taxed at 54%. Dividends, if you've got if shares inside a corporation, let's say shares of Apple or Google or somebody paying out dividends, usually it's the banks and the insurance companies, dividends are taxed at 34% automatically, the first dollar. So there's none of this gradual tax rate or different tax brackets when it comes to passive income. And so what the government has introduced, again, to further further deter from having these investments inside a corporation, is the concept of a small business deduction rate clawback. And basically what they did is they determined that if a corporation has $1 million invested in shares, let's say, and it's making 5% dividends, or it's a $1 million GIC at 5%, the government has decided that if you're earning passive income of 50,000 or more inside a corporation, well, that one tax bracket, that $500,000 profit, is going to be ground down to zero. If between the $50,000 in investment income and up to $150,000 in investment income, there that small business deduction is eliminated. So if you've got this, let's say our earlier example with the $10 million inside the corporation, and you're earning that $150,000 of interest in a GIC, well, all of a sudden, the tax rate on the active business income that you have is now at the 26.5%. It's at the highest rate for active business income, plus you're paying the highest rate on that interest. So there's a big deterrent that the government introduced a few years ago. And so again, with proper planning, we have solutions to, instead of putting $10 million in a GIC, take that $10 million and invest it somewhere else where the tax rate is lower, or the tax rate is deferred, or we get it out of the corporation altogether using other solutions. And that's what we're going to talk about next.
Correct. So the concept that we're talking about in terms of the small business rate clawback, I call that the pig, the passive income grind, right? It grinds down. So like you said, in the first 500,000, the tax rate is 12.2%, and then anything above the 500 is 26.5%. But the clawback is for every dollar that you make in interest, or in interest, any dollar that you make above the 50,000, because the first 50,000 the government allows you. But any $1 above that, the government claws back $5 from your small business allowance. So if you make 100,000, which is a total of 150, but you make 100,000 more, then it just grinded down 500,000 of your allowance, which means on your passive income from OHIP, from consultancy, from whatever, the first dollar is not taxed at 12.2% like everybody else. It's actually now taxed at 26.5%. So this grind is massive. So in the past, we were told, hey, keep all your money in your corporation and use that money to invest and make passive income, using the money in your corporation, which made sense back then. But then since then, the government came in with this passive income grind, which now started grinding down this benefit. And so by using your retained earnings in your corporation to invest is no longer as smart as it used to be. I mean, it's still smart, but not as smart. So let's go to some of the solutions that are smart now. What are the new smart solutions in 2025? You mentioned a few of them.
Yes.
Let's name a few of them. We don't have to go into detail because this podcast would never end, but let's just
Right.
name them and a little bit of why that is.
Okay, so earlier we talked about buying insurance policies inside a corporation. So um, specifically a whole life insurance policy where part of your premiums go towards paying the life insurance coverage, but also going into a separate investment account whereby the life insurance company is going to pay you a dividend into your life insurance policy and therefore giving you a pot of money that's accumulating inside a life insurance policy that's accessible during your lifetime. So I kind of see it as a forced savings. Yes, the premiums are a little higher in a whole life policy than term, but with a term, at the end of 10 or 20 years, you've paid all those premiums, but you have nothing to show for it. And in fact, if you want to keep being insured, now the premiums have more than doubled or tripled in those 10 or 20 years. So now it becomes unaffordable to keep those term policies alive. Whereas with a whole life policy, it's paid by the corporation. So you're paying with that 87-cent dollar, not the 46-cent dollar. So you can actually afford more. And at the same time, you're building up a cushion of savings. And ultimately, like we said, death is 100%. So that life insurance, although it's inside the corporation, is still available to your beneficiaries to help pay your taxes. Another option that is not considered part of this pig is a pension plan. So if you're incorporated and you're paying yourself a salary, you would qualify for a pension plan within your corporation. And it's not just any pension plan, it's one that is governed by the Pension Act of Canada. That means it's just as powerful as the government employees, the Ontario Teachers Union, and a few others. And the Pension Act specifies that the monies invested in that pension fund must earn a minimum of 7.5% rate of return. And how do they determine that? Well, every few years, the pension has to go through an actuarial valuation, meaning that any goals that you set up at the beginning of setting up that pension plan, the actuary says, well, is there enough money in the pension to meet those goals? And for whatever reason, however that money was invested, if you're earning less than 7.5% rate of return, well, now all of a sudden the corporation can top up and make extra contributions. And those contributions are tax deductible to the corporation. So now I've saved at least 12.5%, maybe 26.5%, depending on my tax bracket. And the government says I have to earn at least 7.5% in my pension plan. So 12.5 plus 7.5, I'm earning 20% and I haven't done anything yet. Show me a investment out there that does a guaranteed 20% rate of return without doing anything, just physically moving money from what I call one bucket to another. So the pension plan has many benefits. The one main benefit is that the growth is no longer subject to this clawback because the growth is inside the pension fund, not inside the corporation. You've actually physically moved the money out of the corporation in a tax efficient way because it's a deduction. And now it's growing inside a pension plan. And you're only going to pay the taxes when you pull it out into retirement. So this is another way of saving money with a corporation. I could go on. There's 15 other ways of investing in a corporation, but I'm not an investment advisor. I am a tax man. So all I can tell you is there are several different types of investments done inside a corporation that will minimize, defer, sometimes eliminate the taxes for you at the corporate level. So this is really why Vu and I have put this podcast together to really bring that to your attention.
And that's right, Norma. I mean, we're not in a 45-minute, 60-minute podcast giving the secrets to the world. I mean, they are the secrets to the world. To be honest, we just gave them away, but we're not detailing them because it will take us 4 or 5 hours to do that. But to your point, we just want to build the awareness, right? We want to build the awareness. At least, the thing is, you don't know what you don't know. And so now that you know, you can say, wait a minute, this is worth looking into. This is worth understanding. This is worth me talking to my accountant. This is worth me talking to my lawyer. This is worth me talking to my financial planner, because I didn't know about this before. But now that I know this, I'm going to do a little bit deeper dive and then talk to the experts. And this is what Norman and I are trying to do, is just bring the awareness out there, bring this to light so that people are now aware what they should be aware of, and have those conversations, because you cannot have those conversations unless you are aware of them.
That's exactly right, Fu. And it's often one thing that even financial planners aren't fully aware of these type of investment opportunities. And so it's really comes down to working with the right people and getting the right players on your team, if you will.
That's true. That's true. Again, not all people are created equal. We love to work. Some people don't love to work. I don't know why we're created that way. But so everybody has their own skills and their own competencies, and you just really need to find a person who truly understands this.
Yeah, absolutely. And like anything else, like I said, everybody's got their comfort zone, or their specialty that they're focused on. But we're trying to bring certain concepts to light here. And just again, if a few light bulbs go off, bonus. If not, if you're not sure, then consult your local professionals.
Wonderful. So listen, Norman, thank you very much for this conversation. We're gonna wrap up here. So I asked all my guests the same question, and now that we've talked a lot about a lot of things, some people may just be confused and have to listen to this podcast a few more times. But if I were to ask you, what needs to be said by you today before we leave, that's burning off your chest, you need to say it to my audience, what would that be?
Plan your affairs in such a way that you can sleep at night and that your family will be safe.
I love it. It's simple. It's simple, but difficult, but simple. Uh,
I
and
didn't
and
say
it,
it was
it
I didn't say it was easy. I just said
not easy, not easy. Simple, but
no.
not easy, but needs to be done.
Yes.
So thank you very much, Norma, and I hope you and I will have opportunity to chat again next time.
Yes, thank you very much for your time, Vu, and to all our listeners. If you want more advice, please reach out.
Wonderful. Okay, cheers, everybody. Thank you for listening this far, and I hope that you have understand the big message around this topic. And that message is twofold. One, taxes are the biggest wealth destroyer, and we need to plan around that. And we need to plan for that, especially for deemed disposition on death. And the second message is the planning is important, and it needs to start early. We don't plan when we're about to retire, or worse, when we're about to die. We need to plan early as possible, so that we do not leave a mess to our children and to the rest of the family. Thank you very much for listening this far. If you have enjoyed this podcast, please share it with your colleagues, because I am sure they need this information as well. So please share widely, share with everyone. I hope that you will all be back next time for future episodes of How is My Financial Health Doc podcast. Bye-bye for now.
How is My Financial Health Doc podcast is hosted by Dr. Vu Kit Tran. Dr. Tran is a physician with a special interest in personal financial security and wealth education. Dr. Tran does not render or offer to render personalized investment or tax advice through this financial podcast. The information provided is for informational purposes only and does not constitute financial, tax, investment, or legal advice. Please confer with your advisor, lawyer, or accountant for specific advice.